Okay, so in chapter 14, we'll keep working on corporations. Corporation is a big topic. So we have learned a little bit on chapter 13, and we are continuing to work on this topic on chapter 14. So there are probably 5 or 6 learning objectives. The first one is I'm going to explain to you what are stock dividends, stock splits, and what their financial impact to the company. Stock dividend, right? So in chapter 13, we learned about company will declare a dividend, and they are going to pay the dividend to the shareholders using cash, right? So that's what we have learned. Stock dividends is a dividend, but it's different from cash dividend. So for cash dividend, you use cash to pay the shareholder, but stock dividend is that you give the shareholder stocks, shares. Okay, that's called stock dividend. So when you issue stocks, additional stocks to a shareholder, okay, that does not cost any cash. Okay, so basically, it will not change any assets. Okay, by issuing stock dividends, you are not giving up cash, so your asset will not change. Okay, and your shareholder equity will not change. So what really happened is your return earning, right? Because when you issue dividend, remember, dividend will reduce your return earnings. So when you issue stock dividend, your return earnings will decrease. Okay, and in the same time, another equity account will increase. That's the share capital. Because when you issue stock dividends, you are giving additional shares to the shareholders, so the share capital will increase. So what happened in this transaction is that the changes happened between 2 equity accounts. The net effect to the equity account is 0. So one equity account return earnings, that balance decrease. Another equity account share capital balance increase. So you are shifting some of the balance from return earnings to share capital. Overall, that equity account balance doesn't change, right? That's the stock dividend. It didn't take you cash to pay to the shareholder. It takes you additional shares to pay the shareholder. Okay, so this is one example. Suppose you can see that this is the information about the shareholders' equity. Before the stock dividend issued, the total number of common shares is 50,000. And the number of shares, the total shareholder equity is $800,000. So out of that, $500,000 is the common shares, and $300,000 is return earnings. So this is before the stock dividend. So we know that you have 50,000 shares, and the common shares value is $500,000. So $500,000 divided by 50,000. So we figured out each share would cost average cost for each share is $10, right? Okay. So that's the average cost. Okay. Now, the company issued a stock dividend. Okay. So the average cost of the share is $500,000 divided by 50,000. So the average cost for each share is $10, right? Okay. Now they are issuing additional 5,000 stock dividend. Okay, so the issue dividend, okay, the issue a stock dividend, and the number of shares increase is 5,000 shares. So now you have 55,000 shares. Okay, so the value is $15. Okay, at a point. This is the fair market value. Okay, so when you declare the stock dividend, at the time of the declaration, when the dividend becomes payable, that fair market value is $15, and you issue 5,000 stock dividend. So $15 times 5,000, so that's 75,000. So that's your 75,000. So where does this money coming from, right? The dividend comes from retained earnings, right? So your retained earnings decreased by $75,000. And now the balance for return earning is not $300,000 anymore. It is 225,000. Well, in the meantime, your common share increased, right? So your common share increased from $500,000 to $575,000. Okay, but if you add them up, the total is still $800,000, right? The total is still $800,000. So in this case, the asset doesn't change, shareholder equity doesn't change. What changes happened within the equity. So return earnings decreased, common shares increased. Okay, so does this make sense, Anna and Hasley? Does this make sense?
Yeah.
Yes.
Okay, that's nice. Thank you. Okay, so that's what happened to the stock dividend. And now tell me, what's the average cost of the share after stock dividend? What's the average cost of the common share per share after the stock dividend? So before it's $10, right? Yeah.
I have that is 10.45.
Okay, so we use 575,000 divided by 55,000, right? And what do you get?
10.45.
Okay, 10.45. Yeah, that's correct. So my question for you is, how come the average cost per share has increased? It was $10 on average per share. How come now the average cost after the stock dividend has increased? So you have 5,000 shares, additional shares. How much did you pay for those 5,000 shares per share? So you add 5,000 shares. How much did you pay per share for the 5,000 shares?
15.
15,
15, right? Yeah.
Yeah. So if you are paying before the average cost is $10, right? Now you pay a higher price, $15 per share for additional 5,000 shares. Then when you work together, of course, your average will be higher than before, right? Does that make sense?
Yeah.
Okay. So why we need to issue stock dividend? Okay. Why we need to issue stock dividend? So first of all, let's say the company doesn't have extra cash, right? So the company doesn't have extra cash, but the shareholders wants to have a dividend. what are you gonna do, right? Well, you want to give them dividend, right, to meet their expectations, but at the same time, you just don't have the cash to give out, right? So you give them stocks, okay? The second point is when you are when you issue common shares, okay, you are increasing the number of shares available in the market, okay? So therefore, the price will decrease, right? In the economics, right, you have learned that the price is determined by the supply and demand, right? If you have oversupplied, price will go down. If it's over demanded, price will go up, right? So when you issue more shares, there are more shares available in the market. What happened is, right, you have more stuff in the market, the price will come down, right? The price will come down. So in that case, the share price is lower, and therefore maybe more people can buy it, right? More people will buy it. So before the share price is 1,000, a lot of people don't have 1,000 to buy a share. But right now, because you supplied lots of more shares, the share price is down. So then maybe it's $500, you are able to afford it, right, to buy one share. Okay, so when you converted retained earnings to share capital, right? So the retained earnings balance will be reduced, right? So basically, the idea is those retained earnings has been locked in the share capital. Instead of giving you money, I give you more share. So your investment is heavier than before. Okay, yeah. So the journal entries, similar to the cash dividend, you have a declaration date, okay? You have a record date and a distribution date. So on the declaration date, you have to recognize that liability, right? The moment you declare the dividend, it becomes liability. The company has to pay. So you record liability, so that's called a stock dividend distributable, right? So it's not like you pay a cash, right? You distribute stocks. So therefore, we use the account's name called stock dividend distributable, okay? And then you debit the dividend, you debit stock dividend, you credit stock dividend distributable. On the record date, this is the date that you will know who is eligible for this stock dividend, right? So that's the date. You pull out a list where the names, the shareholders are eligible for receiving that stock dividend. And then on distribution date, you will increase the common shares, you issue the common shares, and you would decrease the liability, right? So you debit stock dividend distributable and credit common shares, okay? So does this make sense? Does this journal entries make sense to you?
I have one question regarding the second one. Could you explain again the record date?
The distribution date?
No, the second, the record date.
Record, yeah. So you declared on the declaration, you know that the company is liable to pay, right? So now, because the stocks are traded frequently, right? So one day you are the shareholder, the next day you sold your stocks to another person, right? You are no longer the shareholder, and the company has a new shareholder, the buyer. So the question is, the company it has a liability, it's payable, but to who, right? So to who this dividend should be distributed, right? So they have to have a date, like they will say, well, on this date, if you are my shareholder, okay, you are going to receive the dividend, right? If on that date you are not a shareholder, sorry, you sold your shares too early, right? Or you buy your shares too late. Does that make sense?
Okay, yes.
Okay. So now another one is called a stock splits. Stock splits. I'm going to tell you a story, so that will help you understand what stock splits that works for, right? You know, there is a very special stamp, right? So you know, some of the rich people, they would collecting antiques, right? Precious, like collections, coins, stamps, right? Those are for the collection. Those, you know, very rare, and they are hoping the value will appreciate, right, in the future. So there is a set of stamps, postal stamps. There are only 4 of them in the world right now remaining. Okay, there are only 4 stamps. It's one side, right? It costs lots of money. Probably cost I forgot, maybe like $10 million. Yeah. So $10 million. I think the cost probably is $10 million each. Like there are 4. So 4 postal stamps for collection, and in the auction, each one is 10 million, right? Okay. So then what happened is there are 4 stamps, each cost 10 million, and the buyer purchased the 4 of them. So the buyer paid $40 million to buy the set of the 4 stamps. And that's all left in all over the world, right? And so you know what this collector did? So he, in front of all the media, right? He opened the bag, and right away he was destroy 3 of them. Okay, so he's like destroying 3 of them. Okay, and then he made an announcement right away saying that there is only 1 left in the world. Okay, there is only 1 left in the world. So the price of that stamp was 10 million before this guy obtained it. Now he destroyed the 3, only 1 left all over the world. Can you tell me what is the price of that stamp remaining?
Probably much higher, right?
Much higher, because it used to be
It's
4,
the
right?
only one.
Right now there's only
Yeah.
1 left. Yeah. Right. So at the minimum, that guy paid $40 million, right? So at the minimum, so this stamp is going to cost 40 million, right? Okay. So in this case, you can see that when you have less supply, right, the price will go up, right? The stock split works the opposite way. So before you have 1 stock, they will do a, let's say, a 1-to-1 split. So now you have 1 stock, now it becomes 2 stock, right? So I used to own only 1 stock. I don't do anything. The company made a decision to do a stock split 1-on-1. So now I get 1-to-2, right? So from 1 stock, I have 2 stock. What do you think that will do to the stock price? So let's say before the split, each stock, the value is $10 on the market. After the stock split, what's the price, do you think?
It probably doubled, like 20 then, or not?
You have more stocks right now. After the split, you are going to have more stocks. So your
Yeah,
price will be higher or lower?
higher. Because you were saying is the opposite, right?
Yeah. So you have 1 stock, and now you have 2 stocks. So in the market, the volume of stocks is doubled, right? So think about the economics, right? If the supply is doubled, what does that do to the price?
In the economics, it decrease. It
Decrease,
makes the
right?
price
Yeah,
decrease.
decrease. Yeah. So my stock, one stock used to be $10, and now it's gonna be $5, right? It's gonna be $5 because the volume of stocks is doubled, right? So the price will be half, right? Will be half. And why the company will do the stock split? Well, they can make the stock affordable, right? Let's say if the stock per share is $20,000, you probably cannot afford it, right? And I probably cannot afford it either. Just to buy one share, it takes you $20,000. But what if I don't have $1,000, right? $20,000, right? So the idea is if you do stock split, there are more stocks in the market, and the price is lower. So it will make it more affordable to more investors, right? So that's good because the company would want to increase what do we say this marketability, right? So if you are kind of reaching more people, if more investors can afford your shares, you are increasing the marketability, right? Okay. But this will not affect the equity account, right? Because they didn't issue dividend, right? They didn't issue new shares. What they did is they split existing shares. So that stock split will not affect shareholders' equity. Okay? Does this make sense?
Yeah.
Anna, does this make sense?
Yes.
Okay, thank you. So now let's take a look at what happened before and after stock split. We're using the same example. This is the 1-2 split. So they used to have $50,000 shares. When we do a 1-2 split, so that number of shares will be doubled. So the new number of shares is $100,000. But it's not going to change the common shares because I didn't issue any new shares. What I did is I split existing shares. And the return earnings will not change because I didn't give any dividend, right? So my total shareholder equity doesn't change. The only thing changed is the number of shares available in the market, right? So that is the effect of the stock split. So now let's compare the three different actions: cash dividend, and the stock dividend, and the stock split. Okay. So tell me, let me ask you guys. So tell me, how does cash dividend affect the asset? How does cash dividend affect the company's asset? Does it increase the the asset, or decrease the asset, or no change?
It will have like an effect. The cash dividend, it will decrease the assets.
Very good. Yeah, because you use the cash, right, to pay the shareholders. So the asset, the cash will decrease. What about the shareholders' equity for the cash dividend? How does the shareholder equity change when you issue a cash dividend? So shareholder equity has two main components, right? You have the share capital and the return earnings. How does the cash dividend affect return earnings?
It will decrease.
Decrease. How does how does cash dividend affect share capital?
I don't know. I guess it doesn't have any effect.
No, yeah, you're right. Right. So basically, the cash dividend will decrease cash and decrease shareholders' equity, right? Okay. And then we just learned that for stock dividend, does that change your asset if you issue stock dividend? Does that change your asset?
No.
No. Does that change your total equity? Stock dividend. How does the stock dividend change your return earning?
Decrease.
Decrease. And how does the stock dividend change your share capital?
You will increase
Yeah,
the
increase.
shareholders' equity. Yeah.
Yeah.
Well, the share capital.
Yeah, because you gave them additional shares, right? Yeah.
Mm-hmm.
Yeah. What about the net effect? Right. So one account decrease, one account increase. What about net effect to shareholder equity?
The what? Sorry.
The net effect to shareholder equity. It does not affect shareholder equity, right? Because the amount of increase in the share capital equals the amount of decrease in the return earnings. Yeah. What about the stock split? How does that change your asset and equity?
Nothing. It doesn't have any effect.
Yeah, so that's this table, right? Cash dividend will decrease asset, decrease return earning, no effect in share capital. Stock dividend has no effect on asset. It's going to increase your share capital, decrease your return earning. Stock split does not affect any of those three accounts. Okay.